All right, good day, ladies and gentlemen. We are delighted to welcome you to the webinar, the role of Chief Risk Officer in Risk Oversight and how to measure its effectiveness. This webinar is proudly organized by Center for Risk Management and Sustainability, CRMS, and the DCRO, Directors and Chief Risk Officer Group, along with the support from Indonesia Professional Risk Management Association, IRMAPA, Indonesia Compliance Professional Association, ICOPI, Indonesia Professional Audit and Control Association, IPACA, GRC Association, LSPMKS, Lembaga Sertifikasi Profesi Mitra Kalyana Sejahtera, and also Enterprise Risk Management Academy, ERMA. So ladies and gentlemen, before we begin the webinar with the welcoming note, I would like to inform you our only one ground rules for today's webinar. So for all of you, if you have any questions, please write down your questions in the Q&A section. In the Q&A section, it is at the bottom of your screen with the format, name, company, the name of your company, your question, and to whom you would like to address the question, to which panelist. Okay, ladies and gentlemen, and all selected questions will be answered in the Q&A sessions. So we will gather the questions first, and all the questions will be addressed during the Q&A sessions. So ladies and gentlemen, we are now opening the webinar by listening to welcoming note by Dr. Antonius Alijoyo. Dr. Alijoyo is the principal of CRMS, chairperson of Audit Committee of PT AIG Indonesia. He is also a board member and independent commissioner in many global companies, and also chairperson of Indonesia Risk Management Professional Association. So I would like to invite Dr. Antonius to deliver his welcoming notes. Please welcome Dr. Alijoyo.
Thank you so much that we got an opportunity to share each other today, together with my colleague, Honorable David Koenig from DCRO, Director and Chief Risk Officer Organization, where he is a founder, and also Todd Davies, a very renowned and honorable person that involved in many things about risk management governance across the globe. Also with Linawati Wijaya and Suryo Ribo Suroto, who are the practitioners in Indonesian entities who are willing to share together with all of us about Chief Risk Officer effectiveness. Now, we are also thank you to the organizer that represented by the host, Mr. Fajar Braboseno. Thank you so much. Now, as already decided by the host, I'm supposed to share with you about the effectiveness, how to measure it, the Chief Risk Officer, how do they do it? How do they add value to the organization? In this case, let me share some presentation slide. Okay. The title of the slide, the role of Chief Risk Officer in risk oversight and how to measure its effectiveness. When we talk about the effective risk oversight, basically it refers as a board duty. And in this case, so is the CRO, whereby he's supposed to understand the entity's risk philosophy and concur with the entity's risk appetite. In this case, he's supposed to know the extent to which management has established effective ERM of the organization. And he's able as well, he or she able as well, review the entity's portfolio of risk and consider it against the entity's risk appetite. Lastly, he's supposed to be apprised of the most significant risks and whether management is responding appropriately. In here, I highlight the third point with the red color. Review the entity's portfolio of risk and consider it against the entity risk appetite. This is the very critical things that expected of what we call it effective risk oversight. It means risk oversight, effective or not, means then the effective board oversight is a contingent on the ability of the board itself to understand and assess an organization's strategies with risk exposure. Therefore, board agenda time and information package that integrates strategy and operational initiative with enterprise-wide risk exposure will strengthen the ability of the board itself to ensure what? To ensure the risk exposure are consistent with overall appetite for risk. This is, we call it effective risk oversight. And what is the role of CRO and how to measure their effectiveness? I pick up from the world-class risk management script by Norman Marks in 2015, whereby he mentioned a couple of things talking about the world-class risk management. In this case, is the CRO. I put 20 items as Norman Marks basically stipulating in his book, but I highlight some very important quotation with the red color. Let's have a look on here. The first page talking about each item. The first one is very important, helping the organization to succeed. So CRO that could be effective if he's helping the organization to succeed rather than simply avoiding failure. So this is a very important. We cannot call a CRO effective if he just say, okay, this is not, he become doctor. No, just avoiding failure, but not helping organization succeeding. Second, I jump to the number 7, willing to recommend taking more risk where appropriate for the business. So this is something that he could synchronize whatever he's trying to advise, whatever he's trying to say, recommending even taking more risk with the right capability, which is appropriate for the business and for the creating value of the organization. In so doing, of course, then he needs to have deep understanding of the business, how to deliver value, how to organize it, make decision and run. He become a trusted and valuable partner, not just a police, just say no or just stop everything. He's supposed to listen before speaking. Then he looks to enable management to identify, assess, and evaluate risks rather than being the authority themselves. Constructive management is a good idea. And lastly, helps everybody consider all the things that might happen, the multiple effects, either positive or negative, that might flow from an event or situation. So again, effective CRO is helping the organization to succeed rather than simply avoiding failure and willing to recommend taking more risk where appropriate for the business. Move on to the next slide. I jump to number 15. Here, Norman said that avoid enterprise risk management. CRO is supposed to avoid enterprise risk management, just coming with the list of the risk, the register of the risk. He's supposed to be able to provide actionable, useful information to leaders of the organization and then help them understand the likelihood of achieving each of their objectives. In other words, they are supposed not simply managing the so-called top risk out of context. They're supposed to bring the top risk as in of the context of the business for the decision making. So in this case, he's supposed to communicate effectively, persuasive enough, speaks well to the authority, an effective facilitator of discussion, help everybody understand, identifying, assessing, evaluating, and responding to what might happen, or the risk in this case, helping his executive achieving their objective by making well-informed, intelligent decision-making, and enables an active discussion about strategy, setting of objective, and then addressing the major project of the management and other key success matters in the organization. Move to the last slide, where the Norman identify what is the effective CRO. There are 5 here, but I would like to highlight one very important. CRO is a leader. He's supposed to ensure the decision maker have useful guidance on which risk to take. He's supposed to work effectively with internal audit, and then potential leader of business operation. So people talk about the business operation, not talk about the risk management jargon. They're supposed to be objective and able to speak as independent voice when necessary and appropriate. So in the last of the excerpt of the Norman, he said that technical risk management expertise even is not one of the 20 items above or identified. In this case, he closing his book with the question, technical risk management expertise, should it rate higher than any of the 20 items above? So then, in this case, he would like to say that it's okay, important to have technical risk management expertise, but it is a basic. If you are supposed to be effective, then you are supposed to have the 20 items above. It's more on the soft skill, persuasion skill, persuasive skill, communication skill as a leader, and supposed to talk about the top risk in business context, supposed to help the organization succeed, not just simply avoiding failures, and willing to recommend taking more risk where appropriate. And now I go to my own slide, then quoted from my own book, Enterprise Risk Management using ISO 31000, where we are trying to highlight like this. If we talk about effective chief risk officer, standing point here, it means what? It means the organization able to implement effective enterprise risk management. We cannot say any chief risk officer in any organization effective or not effective if enterprise risk management in that organization is not effective by itself. So effective enterprise risk management equal to the effective chief risk officer. In so doing, we are supposed to make it sure as well that effective enterprise risk oversight that should be carried out, should be conducted by the board, or sometimes we call it as risk governance leadership. So effective chief risk officer supposed to accommodate, supposed to embrace, support the board in overseeing the enterprise risk management. Here, how to measure it? Then effective enterprise risk management and the effective chief risk officer that embrace the effective enterprise risk oversight. There is a tool we all know, we call it enterprise risk management maturity, that usually scores from 0 to 5. This is not just a document, but this is a kind of a tools to help us to measure ourselves, whether our enterprise is effective or not, PRV then, our chief risk officer effective or not, and seeing the board supposed to make sure that total organization risk exposure still within the risk appetite, then the oversight should be then reflected in the enterprise risk management maturity. My slides show then, I pick up one of the risk management maturity assessment that based on the ISO 31000. Here, there are 6 attributes that being picked up in assessing whether the risk management maturity in organization supposed to be which level. Then start with the risk management framework, risk management process, the management process itself, overall performance management, risk culture, resilience, and sustainability. So when we talk about risk management, you can start with having risk management framework, process, and then integrate it with the risk, with the management process as a whole, okay? Then supported by performance management. But we are not supposed then to let the organization stop only dealing with the current risk. They're supposed to build the capability to embrace the risk not only today, but also tomorrow, the day after tomorrow, and all the future characteristics. Here, the risk management maturity, say for example here, they give a kind of the 5 level from initial up to optimized. If we look at this one, yeah, say initial, risk management still ad hoc, relies on individual initiative. It is still silo and limited to a particular risk aspect and used to manage only certain risks and rely on corrective action. Yeah. If we go to the optimize here, yeah, jumping over to optimize, risk management is an integral part of organizational governance and management, systematically and consistently practiced as per ISO 31000 risk management guidelines standard. In this case, the CRO is successfully to make it sure that internalized and rooted the organization culture with the risk management itself. The strong competency is there, leadership is there, and commitment to the risk management is there. Positive behavior in managing risk has been manifested throughout and at all levels of the organization, supported consistently with reviews, corrective action, and improvement as needed. It becomes a strong pillar of business resiliency and sustainability. Those can only be achieved if the chief risk officer are or is able to perform as what we have already discussed, the 20 trade or 20 items that Norman already identified in his book. So then, may I say as a closing, yeah, measuring the effectiveness of chief risk officer both in risk oversight and risk management can only be seen equally to how effective the enterprise risk management itself. In this case, it can be measured, it can be translated into how mature then your organization ERM being in place. In this case, we do hope that any CRO who are able then to sit and participate in this today webinar, then able to bring the organization maturity from whatever your level up to the optimum level that is possible. And if you are already, say for example, already at the manage on the optimized, for example, in the current organization, then use it to help the organization succeeding even a much higher creating value level of the organization. So then, if you are able to make it optimize or manage maturity today, it could then you help the organization moving to the next step of the value creation new dimension that embrace a new uncertainty, embrace a new frontier of risk, and then of course then dealing with the more dynamic challenges of in our future. So this is my short presentation because we are looking forward to the practice sharing made by our colleague David Koenig, Todd Davies, Linawati, and Suryo Rimbo that really that coming from the angle of practitioner and see how then we could learn to measure ourselves about the effective CRO in doing the risk oversight duty in the organization. Thank you very much, ladies and gentlemen. We do hope that it is useful to all of us. Thank you so much. Stay healthy.
Okay, thank you very much, Dr. Ali Joyo, for the very insightful welcoming note for today. So, ladies and gentlemen, without further ado, let's us move on to our first panel discussion for today. But before that, I would like to introduce our moderator to lead the panel discussion today. He is Mr. Fajar Proboseno, CCIA, ERMCP, QRMP, QCRO, QRGP. Mr. Proboseno is former head of risk management and head of internal audits in Astra International TBK. He is currently the CEO of Risk Resolution Consultancy with implementation of risk management in various industries. He is also a member of Risk Oversight and Integrated Governance Committee in IFG and Audit Committee in Indocorsa, TBK. He is also currently Technical Advisor and Master Trainer of CRMS. with more than 5,000 hours of training as trainer and in total of thousands of participants. So I would like to invite Mr. Proboseno to lead our first panel discussion today. Mr. Proboseno, the time is yours. Mr. Proboseno, I think you're still in mute.
Thank you, Nita. Yeah, thank you, Nita, for the introductions. I'm quite nervous because we have 4 distinguished speakers today, and I have to be on their side all the time. Yeah. So for the next sessions, there will be 2 sessions. Yeah, divided in 2 sessions. The first sessions will be brought, by our extraordinary speakers. Yeah, there are Todd Davies and David Koenig. Yeah, let me introduce you who they are first. Yeah, Todd Davies is a best practice advisor in risk leadership. Yeah, he was formerly global head of innovations for KPMG internal audit practice, including introducing risk-based audit worldwide. Yeah, chief audit and risk officer for an ISX 50 company and has helped set the governance frameworks for Australian listed companies. Yeah. For more than a decade, Mr. Todd Davies also chaired complex audit and risk committees and worked with and mentored around 10 to 20 chief audit and risk officers every year. Yeah. And then the next speakers is Mr. David Koenig, also known as author of Governance Reimagined. Yeah, probably also can introduce your book, Mr. Koenig. The organizational design, risk and value creations, in 2012 and 2018, and now also the board member of Guide to Risk on May 2020. Also as the founder of the Directors and Chief Risk Officer Groups, the DCRO, a global collaborative of C-suite and board members focused on the risk governance, and one of the founders of the Professional Risk Managers International Associations. His work over the past 20 years has focused on establishing and implementing global best practices for the risk governance and the board level and the general practices of risk management. Without further ado, I would like to call Mr. Todd Davies and Mr. David Koenig for the presentations. Again, I will remind for the participants who have any questions during the presentations, please do write your questions, in a question and answer column over there. And to start this session, I will call Mr. David Koenig to give your presentations. The screen is yours. Enjoy.
Great. Thank you so much, Fajar. It's so nice to be here. And are you able to see my screen?
Let me see.
Yes.
Okay, good. I just want to make sure I get that right this time, Nita. This is always a great pleasure for me to speak to this group. Anton and I have known each other for, I think, 20 years now. And so I want to express my thanks to the Center for Risk Management Sustainability, to Nita and Anton. I've had the pleasure of working even more closely with them over this past year. And you'll see in the presentation, places where we have intersected. So I am very encouraged to be a part of this. I'm very encouraged by the amount of attendance we have today. Glad that Todd Davies can join us. Todd and I have known each other for quite a while as well. So my role, I think, in this presentation is going to be to try to connect a little bit of what Anton had said in his presentation, because where he was talking is really where we've evolved to. And then Todd as well, when he starts talking about the things you should be looking for and the things that you need in your risk manager, I'm going to try and take us back a bit in time and go through a timeline that really parallels the development of modern risk management. And so if you'll allow me to do that, hopefully this history lesson won't bore you too much. So you can see on this screen, we're going back quite a ways, almost 50 years now. And I would argue that that's when the era of modern risk management began. Now, when I go through this, you're going to see that there's a fairly strong bias towards these historical markers that I put in here towards financial risk management. And that's really because this era of modern risk management began back in 1972 when Fisher Black, Myron Scholes, and Bob Merton all came up with an option pricing model. And Nobel Prizes were awarded for these. This changed the way in which we started viewing risk. Now, as you'll see when I go through this, as happens often over these 50 years, the ways in which we look at risk initially is often faulty. So we're trying to at least gauge how to continue to improve. And I think that that's something that's clearly happening, as Todd will talk to you about and as Anton alluded to. But again, going back here, this is where it started. Now, in 1975, just a few years later, on the Chicago Board of Trade, the first derivative product in the financial markets began to trade, something called a Ginnie Mae futures contract. Now, for those of you who aren't familiar with what Ginnie Mae means, it's government national mortgage authority, and those are mortgages, money that people borrow to buy their homes. Now, you'll see this theme appear quite often here, particularly in the first 20 years of this discovery. Now, in the mid-1980s, the derivative markets began to expand rapidly. And as you'll note on the top, I'm going to go through some of the events in the risk management world which have led to progression, sometimes regression, but most times progression. And on the bottom side of the timeline, it's going to be a little bit more personal. These are things about my own development in the risk management profession, because I think people like Todd and Anton will have had similar experiences, as will many people of our vintage. But in the mid-1980s, in the futures markets in Chicago, which happened to be where I started my career, there was tremendous innovation happening. I was doing in my first work risk management programs for university endowments, for airlines that were hedging their jet fuel, for banks and savings and loans that wanted to hedge their interest rate exposure. It was really creative, and there was quite a bit of value being added at the time. And I will tell you, it was very fun. It was very fun to be at that point of innovation. Now, move forward a few years, and we have now the very first chief risk officer being named. Now, that wasn't a position. It didn't exist until this time. And James Lamb, who's somebody I've known since actually 1992, was the guy who was the first chief risk officer, and he created the title for himself. As he'll tell you, when he got a new job, his boss said, well, what should we call this? And he said, I don't know, there are lots of chief other things. How about chief risk officer? So this is the beginning of the story that's going to lead to what Todd and what Anton had talked about. Now, James and I, as I mentioned, met in 1992. We met at a conference in Boston, where in a back room with maybe 20 people, he was presenting on something called firm-wide risk management. And we'll talk about a progression of firm-wide risk management into what you understand of it today. But I was looking to build a firm-wide risk management program for the mortgage company that I worked for at the time. I ran risk for a company, managed risk for a company that originated and serviced mortgages. So again, going back now to that story about the Ginnie Mae creation and the advancement in derivatives, we were actually a fairly sophisticated house in terms of managing our mortgage risk, which for, as I think you'll see in these next few points, is an incredibly complex derivative risk to manage. So we built the very first firm-wide risk management program in 1993. Now, the timing of that couldn't have been better. In 1994, there were massive derivative losses, and I have massive in quotations because the numbers from back then are nothing compared to some of the things that have happened since. Procter & Gamble and other companies experienced losses in their derivative trading because they simply didn't understand or they didn't account for derivatives properly. In fact, some risk management programs almost shut down because no one wanted to have, quote, derivatives on their balance sheet because of these losses that made headlines. But we had a peso crisis in Mexico, and then the real damage started to be done. In 1994 in the United States, interest rates started to go up dramatically. What happened was a number of mortgage companies and a number of people managing portfolios of mortgage risk started to go out of business. They didn't understand the risk that they had. They had been earning things in excess of what they should have been earning, but the reason was they were taking risks in excess of their understanding. Now, I want to go back to the timing on having created that first firm-wide risk management program in 1993. In 1994, the mortgage company where I ran risk was one of the only mortgage companies in the country to be profitable. To give you a sense for what that allowed us to do, understanding our risk better than anybody else in the business, and I will argue there was maybe one other mortgage company in the United States that understood their risk as well as we did. We were able to move from 23rd in market share to 9th in market share, which was a massive increase. And ultimately, the company for which I worked was sold for something on the order of a $1 billion profit. That came about because of a very integrated approach to selling, to servicing our customers, and understanding the risks. So there is real value that was created in this initiative. Now, let me go forward a little bit, and some of you will remember the Asian crisis in '97, and also the Russian crisis, which was political and commodity-based as oil prices collapsed. This led to additional worries about the financial systems in the world, but nothing like what was about to come. In April of 1998, I gave my very first conference presentation, and the title of my presentation was, "How Wrong Can You Be?" Now, that's an odd place to start your career of speaking, but what I was trying to point out to people was the modeling that we were doing around risk was incredibly sensitive to the assumptions that we were making. And what I pointed out in this presentation was that if you were a mortgage company, again, where I was managing risk, and you used one set of assumptions and were wrong, you could go out of business. Or if you used another set of assumptions and were wrong, you could be non-competitive and you'd go out of business. But one of the risks that people didn't realize, again, was that their models were incredibly sensitive to the assumptions that they were making. Now, in 1998, long-term capital management, LTCM, which, as I reference back to the 1972 beginnings of modern portfolio risk management, modern risk management, Myron Scholes and Bob Merton were members of the board of long-term capital management. This was one of the first times when the financial system worldwide almost collapsed. You know it's not the last time this has happened. You know some of the stories of more recent times. But this is one of the very first times that the markets started to wonder whether banks were going to survive and whether the financial system would survive. And the reason was they had been operating under the assumption that their models were correct, that they could always run arbitrages in very large quantities, and they discovered that those assumptions were incorrect. And it cost their investors billions, but it cost hundreds of billions around the world in losses and disruption to our normal way of living. Not long after that, we had the dot-com boom where technology stocks were soaring to new highs. And of course, in almost all market bubbles, there's a crash that follows. And the dot-com crash in 2000 got us to a point where we were starting to wonder whether this fairly new company called Amazon, which was a bookseller back then, would even survive. This is also when the very first book on enterprise-wide risk management was written. Now, if you'll remember, when James and I met, we were talking about firm-wide risk management. By 2000, the term had become enterprise-wide risk management. So people were starting to think again about these big pictures in a much broader sense, and it was more widely known that this was a good idea. Now, this also happens to be the same time that two international risk management associations were very active. GARP, or the Global Association of Risk Professionals, was offering certification, a technical certification of risk managers called the FRM. Premia, which was an organization that I helped to found and ran for about 6 or 7 years, had a certification called the PRM, or Professional Risk Manager. These were geared towards the technical aspects of risk management, and both were quite successful and helpful for people trying to implement better risk management practices. Now, in 2001, in GARP's Risk Review, I wrote an article called The Evolution of the Risk Manager. The other part of that title was business line advocacy. Anton started talking a little bit about this in his presentation, but what I had seen in risk management roles up to this point was that we were becoming more and more like cops, more and more focused on making sure things didn't go wrong, more focused on not being a headline for some derivative loss or some modeling error or some rogue trader or somebody doing something they weren't supposed to do. And I knew that wasn't a sustainable model. I knew because the company I was working with at the time, I had taken the approach like I did with the mortgage company I worked for and said, how do we use risk to make us better at what we do? How do we use an understanding of risk to make better business decisions? Now, there's a bit of irony in this, in that the company I was working for at that time was one of the companies that almost went away in 1994. They had had someone running a very profitable product for them, appearing on the cover of magazines all around the country. They were a 100-year-old company that hadn't received this kind of attention any time before. And it turned out they didn't understand the risk he was taking. That company had to be rescued by a large US bank. And I came in to help them build a risk management program. Again, our emphasis was not on trying to find everything that could go wrong, but on how we make risk something that helps them make better business decisions. Some of those are hard decisions, like shutting down part of the business that had been there since the beginning, or trying new businesses that may seem risky, saying no to some customers, but saying yes and more yes to other customers. Now, in 2003 and 2004, James Lamb wrote his first book on enterprise risk management, ERM. And this is what's become the standard term, referring to risk management that's engaged throughout the organization. I don't think it's coincidental, but it's certainly a reflection of what was changing the attitude around risk at this time, that the Australia-New Zealand standard 4360 was also published. And I will still say that's one of the best guidances on integrating risk management into your business decision-making as is around. And we'll talk about where that's had some influence. And I think Todd might talk about it a little bit too, in terms of how it helped to advance what we're doing in terms of enterprise risk management. Now, in 2007, I ran a study with a gentleman named Michael Koenig from Columbia University in New York. We started to ask the question about whether boards understood the risks that their organizations were taking and whether there was a good connection between boards and this newly emerging enterprise risk management concept and function. You won't be surprised to know that we found there wasn't. There wasn't a good understanding. And so, in fact, this is when the Directors and Chief Risk Officers group was born. The DCRO was designed specifically, Directors and Chief Risk Officers, to connect boards with the risk management infrastructure of their organization so that they each understood each other's needs and capabilities and understood where they could be doing better. Now, in 2008, I would estimate there were somewhere between 200 and 300 chief risk officers globally. So remember, James Lamb became the first one about 5 years before that. So we went from 1 to maybe 200 or 300 at that point. And then also in 2008, again related to mortgages and again related to people not understanding the risks they were taking, we had the global financial crisis. Now, long-term capital markets, when they blew up, there was certainly fear, and the Fed intervened, and there was fear that the global financial markets were going to collapse. In 2008, the global financial markets started to collapse, and the risk was real, and the intervention became massive and expensive. What we find most times when we don't understand risk well is that we haven't priced it properly. And it's not that we're paying for it when we should, it's that we pay for it in a very large lump sum later on. And that's what happened in the financial crisis. And it wasn't anything isolated to just the United States. In fact, what were just a few $100 million in mortgage losses here turned into trillions of dollars of losses globally. Now, in 2010, building on the work that I had done with Michael Koenig and some of the work that we were doing with the DCRO, I wrote an article for the Conference Board of Canada talking about how risk committees of the board would start to become a fiduciary expectation. And what I mean by that is that anyone who has an interest in the firm, anyone who has some stake in how the firm does, would start to expect that firms had committees at the board level that understood risk better. That's not that shocking. You would think it wouldn't be that shocking after the financial crisis, but there is still a lot of pushback on that idea even today. But back in 2010, I was pushing forward the idea that this is what you should be doing. It's an expectation that any investor or regulator should have of you, whether you're a bank, a mining company, a health services company, anyone should have a risk committee. In 2012, I wrote the book Governance Reimagined, which was designed to lay out the theory and concepts behind how you run an organization well, how you take risk well, how you manage risk well. And again, I'm thankful to CRMS, Anton, and Nitha, because they have just translated this book in its second edition into Bahasa. So I'm sure they can tell you how to get it if you're interested in reading it. But that was a book that helped me articulate all that I had learned up to that point in my career about how we should take risk well. In 2013, just after that, COSO issued their first guidance on risk management. And the COSO guidance was more for internal auditors and accounting. People who had managed risk were not particularly fond of their first version. It felt more like something you would do to just tick the box and check things off and say, we've got one of these. But it did help at least move the discussion forward. And when they revised that several years later, it became a better document. But in 2018, ISO 31000, which was built off of the Australia-New Zealand standard that I had mentioned earlier, took this all to another level. And again, I would argue ISO 31000 is one of the best documents you'll find if you want to understand the governance of risk as it integrates to what you do in your organization. And I'm sure Todd's going to talk a little bit about that when he does his presentation. Okay, so we had LTCM, which looked like it was going to bring the financial world economic and financial system to collapse. We had 2008, 2009, and it looked as if, and it started to be the case, that the world financial system was going to collapse. And then we have a pandemic. Now, in March of 2020, when we saw stock prices falling 30 to 40%, when we saw people dying in hospitals and morgues overflowing, when we had no sense for how this pandemic was going to be managed, how lethal it was, how transmissible it was, again, we were faced with a situation of global panic and some worry that the world economy would shut down. We in the Directors and Chief Risk Officers group were communicating with our members to find out how things were progressing in different parts of the world. And I can tell you that probably 50% of our members were planning for disruptions of over a year to their normal business activities and assigned something like a 30% probability to a global recession where GDP fell more than 20%. There was quite a bit of fear in the markets. And again, we learned the lesson that understanding some of our risks needs to be done better. Our supply chain risks, our just-in-time inventory plans, our political risks. In other words, if you're going to outsource what you do, if you're going to follow the economic model of comparative advantage, you better have good political relationships with the countries that control the supply to your country. In the United States, we had spent a few years damaging all of those, and we started to pay the price here. But we're learning, and people are learning that the cost of just-in-time inventory, lean inventory, and these models of outsourcing may not be realized at the start, but it will eventually, like all risks. Last year, I think as Nitha had mentioned, I wrote the Board Members Guide to Risk. My understanding is that's going to be translated into Bahasa sometime in the middle of this coming year. I wrote this because I wanted board members to feel comfortable about risk. You could go through this whole history and understand why no one wants to talk about risk, especially in the realm of loss. No one wants to talk about something they may not understand well. So I wrote this book so that board members can become comfortable talking about risk, can understand it on a non-technical level, but also about how it fits within their strategy. Now, I mentioned the global pandemic, but a couple of other things that are happening right now are technological innovations, some of them spurred by the pandemic, some of them naturally occurring. And something that Peter Duffy, who serves on the ISO committee for 31,000 and a new ISO committee that's working on governance best practices, he's coined this term quantum risks. And these quantum risks are risks that exist in many different states, but you can't see them until they materialize, and then you know them for what they are. Now that sounds a bit hopeless, but what it's done is to help risk managers in business focus more on resiliency, continuity, and the ability to respond to crises, which again is a central part of being a good organization that understands its risk well. You will never know every risk that's about to hit you, but you can plan for how to respond to the things that you didn't expect, and that's critical. So this past year, the DCRO Institute was launched. That's, I think, now 3 months old. We have a risk management program for board members, an educational program. Todd, who's going to speak in a bit, is one of our case studies in this program. And I wrote an article with David Martin that the Center for Financial Stability published called The Future of Risk Management. What we talk about there is how to take risk management that's been focused on all of these losses and turn it into something that is part of the normal business process. We want to turn risk management into a cost. We want that cost to be allocated in the same way that you would allocate the costs of people, technologies, facilities, everything else, so that it just becomes part of a normal business decision process. We still have quite a long way to go in that, but that's what we see as the future. Now, I mentioned James Lamb, first Chief Risk Officer in 1993. As we headed into the pandemic in 2008, as we headed into the financial crisis in 2008, there were probably 200 to 300 Chief Risk Officers. Tonight, I did a search on LinkedIn to find out how many people on LinkedIn, that doesn't mean everybody in the world, but how many people on LinkedIn have the title Chief Risk Officer in their LinkedIn description. And now it's approximately 27,000. Now, if you're asking, do I need a Chief Risk Officer in my organization? My answer to you is going to be yes, unless you have no risk. Now, you don't have to have somebody who has the title Chief Risk Officer, but you do need to have somebody who's helping your organization understand risk. And you do need to have a structure in place to allow you to manage risk as close as it can be to where it's being originated. And there's a lot that I talk about in both of those books about this. I won't spend that time here, but I do now want to take you into this last 2 slides. I'll go through these in just a few minutes to help you understand why there's so much value created by having a board risk committee, by having a chief risk officer, by having an enterprise risk management program in your organization. And it all begins with the idea that brought your business to be. You had to draw capital into your idea. And that's true whether you're a startup with the very first idea you're bringing forward, or if you have new products and new innovations at your company. If you're in the meeting room where capital is being allocated or permissions being given, you are asking for the freedom from the firm, the capital from the firm to pursue that new idea. You have to start at the idea that I'm trying to attract capital. Now, the organization, as Anton was starting to talk about, is about achieving its purpose, about using this capital well, which is effective risk taking. Businesses exist to take risk. They take different kinds of risks, but there's no reason for them to exist other than to take risk in pursuit of some goal. And we hope we're utilizing this capital effectively, and that's part of where the risk manager can help. These capital providers then get their first reward from us. Did we do a good job using their capital? Did we return their money to us if they lent it to us? Did we return equity dividends to them if they were equity investors? Do they get better career paths if they were employees? Did they get bonuses? Those kinds of things. Those are the first rewards. But that's just the first part of the cycle. Everyone has to consider whether they're going to continue to give you their capital. And this is not feedback. This is something called feed forward. And I will tell you that, and this, I'm not going to develop the whole thing here, feed forward is far, far more important than feedback. Feed forward is an emotion. It's an assessment. Some of it is done by data, but a lot of it is done by what's called heuristics, feelings, senses, ideas that we have. And our risk management function at the board level, at the enterprise level, and our communication around risk and how we take risk well in the organization is what gives these capital providers a better feed forward feeling about us. And that means that not only will they invest their capital again with us, but they'll do so potentially at a lower cost than to our competitors, and maybe at a lower cost to what they had done the first time, because for them, risk is becoming less of a fear. This leads to value creation. That's why our organizations exist. So now, who provides us with capital? I talked about a couple of them, but every single entity on this chart provides you with some form of capital. Investors, debt, and equity. Your leadership provides you with intellectual capital, as do your employees and contract workers. They can take their intellectual capital and go somewhere else. Retirees provide you with oversight because they're interested in their pensions. They're interested in their reputations. We have analysts on the outside looking at us. Creditors, liquidity providers, suppliers, all of them provide us with some ability to pursue our objectives. Now, you might look at regulators and say, what kind of capital are they giving us? Why is it that I would think of as a regulator as a capital provider? Regulators have the ability to take away something that I call freedom capital. That's the freedom to pursue your objectives. And if you lose that freedom, or if it's constrained, it's the same as losing or experiencing constraint on any other capital that you're receiving. It makes it less likely that you're going to be able to achieve your goals. It raises the cost of all of your capital, and it makes it more likely that you won't be around for the long run when your competitors might be. So remember this when anybody uses the term stakeholders. If you start to think that stakeholders are some sort of soft concept, what I will tell you is that every single entity shown on this screen is a stakeholder. Every stakeholder provides you with some form of capital. Your success depends on stakeholders, and your success depends on meeting their expectations, both in terms of feedback and feed forward. And in order to do that well, you need strong risk governance at the board level, at the enterprise level, and in the management of all of your business activities. So thank you very much. I've got my contact information on here. You can feel free to reach out to me, and I think Nitha will make this presentation available to you afterwards. But I'll stay around for questions, and with that, let me turn it back over to Fajar, and you can invite Todd for his presentation.
Yes, of course. Thank you, Mr. Koenig, for very inspiring presentations. This is the first time I've seen the history of risk management, and in particular the chief risk officer. Yeah, it's so like breathtaking to see the history from back to 1972, where I was just born that year. Yeah, to know that this career was was starting from like zero. Yeah. So, but I'm not gonna wasting time with my speech. Yeah, I'm going to Mr. Todd Davies. Yeah, I'm gonna hand over the screen to you, please.
Right. Thank you for the opportunity to share with you today. And David, thank you for your presentation. I'm always struck at how we're always on the same path, operating in parallel with different thought approaches on the how, but always aligned on the what, and we get better for it. I'm just going to try and load up some slides, so just bear with me while I do this. And can I just say, look, it's a great pleasure to be here with everyone in Indonesia, and I see I've also got some colleagues from Australia on the line. Very nice that you could join us too. Now, hopefully, can people see these slides?
Oh, yes, it can be seen beautifully.
I'm trying to get my video back, and we should be on the way. Fabulous. So thank you for that. So in the Australian context, then, David mentioned that Australia has, had a pretty useful role. I think it'd be fair to say, in the risk management journey. And so 4360, according to my recollection, and I could be a bit off here, the mid-90s was when 4360 came about during my formative years. My first degree was in finance, so I just assumed the Black Scholes was something that had always been around. So it shows that I came late to the party, but my specialisation has been in non-financial risk. And really, I guess the things I've been thinking about have been the same as the ones that David has been thinking about. In our context, I think like a lot of places where there's risk management, we have a scandal from time to time that affects share price or affects some other societal issue. And the question is, well, was risk management working? Is it sufficient? And so our first speaker mentioned in Jakarta, the standard you're looking for is operation in a consistent way with risk appetite. Here, there's a slightly bigger question that boards need to satisfy themselves on every year. Is risk management effective? And that's the topic for today. But there is a question about what does effective mean? And it's really, can the share price be moved as a result of risk management done well, or risk management not being done well? So, David mentioned, I think $1 billion of value creation, which is probably better than, the 6% of share price I've been able to move during my career. But if you do it right, or if you do it wrong, your share price moves on you. David, if we get time after the session, we might talk about what's happening in capital markets around ESG, particularly when you've got big pension funds who are interested in non-financial systemic risk. So I'll park that if we get time. So today's presentation is really, when you think about how to manage effectiveness, your chief risk officer and your risk teams could be very good at a number of things. And what we've seen in Australia, because we've been on this path for a very long time, there are a lot of things they could do, and the to-do list adds up, particularly when you've got an overlay of a maturity model and more things to do. And the proposition I'll put to you today is the trick is to work out what it is that your organisation needs your team to be great at. And so they're different things for different organisations. So I'll share with you a bit of a way of thinking about that, and also share some of the Australian experience, because we've been on this journey for a very, very long time. One thing I will highlight though, we've been on the risk maturity path for a very long time. And so you see organisations that reach maturity level 4 on a risk maturity model, and then their share price drops by 30% due to an unmanaged risk. So it does really beg the question, are you effective or not? Or are you going through the motions? And that's really where I'm going to try and go today. So let's get into it. 3 lines of defence here is a big deal, and it's very widely adopted. 3 lines of defence here, at least, came from financial services and banking, where they had the idea, look, internal audit shouldn't be doing risk management. Management should probably have some separation from risk management oversight. You should really strip those things out. So it's pretty entrenched here. It's through non-financial services organisations too. It's very widespread. And so the notion is, management does certain things. Internal audit should pare it back into more of a regulator oversight piece. But there's this bit in the middle. And so the question really is, what do you want your risk function to do? And so there's a range of things they could do. They could find black swans or grey rhinos. They could run the business continuity and crisis management approach. They could do risk reporting, risk frameworks, policy frameworks. They could do compliance and internal control. They could do insurance. So there's a great many things that they could do. The big question is, what should they do? Now, I've lost video here. I'm just going to do a quick adjustment, and hopefully I've got everyone back. Great. Can everyone still see my slides? Right. Let's go through the risk journey of Australia. Now, interesting enough, this timeline here is not dissimilar to David's. I probably started it around about the early 90s when I started my career, just because that's a time frame that makes sense to me. But in essence, the 4360 was useful. It has its limitations, but I think it was a platform that everyone could pick up. And so there's some very useful things there that has helped it mainstream. Like any product or idea, as it reaches saturation points, you need reinvention, otherwise you end up in decline. And for us, there's always a corporate governance issue, that seems to pop up in around about 10-year cycles, whether that's the global financial crisis, 2007, 2008, or other things that have happened. So we've had a few cycles here, some that have driven really good innovations, and I'll cover a few of those, and others that have really just added more people without getting to the heart of what it is that's really important. Material business risk is the standout for me, and also getting boards to think about risk effectiveness rather than just risk maturity. So I'll talk about those shortly. Can I quickly talk about risk maturity models? I've used them, we've all got them, we've all seen them. I've probably developed a few myself. In fact, I might have even helped develop one of the first ones in the late 90s with KPMG. The problem with maturity models is they're often activities without intention. So the assumption is if you cover all the attributes and you do more, you'll get where you need to go. So just do more ERM, do it in a more sophisticated way, make it more repeatable, and you'll be where you need to go. But what the evidence shows here is that you can be very high maturity and you can still end up with major problems. And so we definitely see that here. I'm sure you'll see that in other markets. I see about 20 risk functions every year. I've never seen two alike. They're different and they need to be. So risk function is often informed by good practice, and we copy and we graft and we adopt. There's lots of good practice to choose from. But the key message I would leave you with is tactics without clear intention on what you want to be great at won't get you where you need to go. It'll generate a ton of work and cost. So then fast forward, and I find myself on interview panels, as an audit and risk committee chair, trying to hire a CRO. And there's lots of CROs now. There's people who can do the job. There are some fantastic people, including some of the people on this call, who you would hire in a heartbeat. The question is, what is it that you want your organisation to get from its risk team at this point in time? And what I find is that organisations need clarity on this, and hence, we developed a bit of a model late last year, which I'll share with you now, around certain attributes of what a risk function could and should do. This may be hard to read, and we'll get something out afterwards. But in essence, you have an organisational design and a way of working. I've borrowed from the McKinsey 7S model here, but you have a structure, systems, style, staff, skills, strategy, and then at the centre you have shared values and culture. So each organisation is unique in these respects, and therefore the risk function could either be a standalone silo, or it could integrate in the way that the organisation works. And for people who read the updated ISO 31000 and COSO ERM that came out in 2018, the mantra was no silos, no separate process, no additional work to do after hours. It's got to be embedded. So having an understanding of the organisational design is really important to understand what attributes to embrace. Then you design the risk function. And then lastly, you work out what your assurance functions are for your internal audit function. So internal auditors never like a vacuum. And so if there are things that are undone, the internal auditors tend to lean in and do either gap analysis or sometimes roll up the sleeves, which can be problematic. These days, internal audit functions are more about assuring the frameworks, and reviewing line 2, and reviewing your risk function. But they can only do that if the middle bit, the risk function, is great. And so I'd just like to cover that briefly. The model has 16 elements that are pretty common for risk teams. It's not everything, but very commonly these are the ones. And I'll just take you through it briefly. So in the middle, on the top row there, principal risk assurance and controls assurance. So principal risk assurance is that the principal risks are known. Now, principal risks is a term that comes from the UK, I believe. But in essence, the things that could really swing you around are really the ones we're talking about here. And the things you really need to be on top of always are your principal risks. So they're known, they're confirmed, and you know the status, including control status and where you're at. Controls assurance, the right controls in place and working effectively. So there's a pairing there. Next row down, risk decision support. So if you're going to do a major investment, divestment, a major acquisition, merger, that sort of thing, do you want your risk team looking at this stuff and doing the pre-vet and assisting the decision making all the way up to the board? Or is it a gatekeeper regulator role? So the risk approvals are sound and the risk limits are adhered to. Next run down, strategic risk and emerging risk. So strategic risk, is your business model okay? And if not, are you positioned well? To make sure that you're positioned strategically. Emerging risk, do you know what's coming? And are you ready and well poised for when it does? So this is the black swans kind of grey rhinos space. Next rung down, our framework owner sets the risk and control frameworks, including risk appetite. Or is it a capability builder? So is it a centre of excellence where you do the risk work for people? Or is it something more of a capability build within the organisation that trains capability close to the source of risk? It's something more like a Six Sigma or a black belt type program. Next run down, board support, which is the strategic bit, helping them lead effectively and make great decisions. Or is it a handle turning role, which is just managing the risk system, getting the data in, not keeping management buried in that. And we keep going. There's more a risk team could do and commonly does. Policy frameworks, not just for risk, but for everything, or policy compliance with those frameworks. Then you enter insurance and risk transfer. I'm not talking about financial risk here, just the insurance side of things. Selling the risk profile and getting good pricing on that, managing the claims. And then lastly, resilience and emergency management. Now, quite often what happens, and I'm thinking about someone who's on the call, it's, yes, can you do all of that, please? And by the way, you've got a tiny team to get it done. Others, could be more strategic, which is, look, there is a small handful of things we'd really, really like you to focus on and get right. And if we do those things well, we will thrive and prosper as an organisation. So I might cut ahead then to what the findings were of the study. So we surveyed around about 30 organisations, pretty much all were mature risk teams, mainly from large organisations in Australia and a few abroad. And this is what we found. So the items involved, there were 6 areas that were really important. So principal risk assurance and controls assurance is now seen as very important here. If you get that right, your enterprise risk function and program is good. If not, you've probably got a ways to go. Strategic risk and emerging risk has been really hot here for a long time, but I think there's an acknowledgement that we need to be better at it. And then next down, in terms of the bold items, framework owner, capability builder were also seen as very important. So they're the priorities, noted by the blue bars. But then when you look at performance, and I'm talking about here about the amber boxes, principal risk assurance, controls assurance are not as good as it needs to be. Risk decision support, perhaps not even having a seat at the table. As the chair of the audit and risk committee, I quite often ask, have you run this past the CRO? And often the response from the chief executive is, well, no, we wouldn't get them involved. It'd be the wrong discussion. Strategic and emerging risk. I've been working with a futurist for the last dozen years, trying to work out where the black swans and grey rhinos coming from. I think a number of those are pretty clear. If you read Michelle Walker's book, and I would recommend it, she'll explain a little bit about why people don't always pay attention. But I think those things are increasingly clear. Framework owner around risk appetite, people think they do that pretty well here. I think the jury's still out on that. A lot of process, and we're pretty good at handle turning. So this then shapes up, well, okay, if they're the systemic issues that we need to focus on as a discipline across the board, how can we help? And the ones in amber are the ones I'm working on with clients. But it also varies by organisation. So this organisation, for them, framework owning and capability building was really, really important. They thought they did well on certain things, and there were certain areas they had gaps. I've done about 30 of these, they're all different. And so I think the key thing here is you need to be really clear on what it is that your organisation wants you to do. And then, with performance is never as good as you think it is. It's never as bad as you think it is. And your stakeholders will have a different view from you. So you need to be sure on these things, on how well you're doing. So just to leave that section of the presentation, there's 16 elements there. Have a think about what it is that you want to focus on, and then measure those things before you go down the risk maturity path. Then just skipping forward, risk categories, focusing on the right risks. David talked a little bit about risk taking, and I'll ask him to lead that part of the conversation after the break. I'm very focused in a risk management mindset, and it's because most of my committees are audit and risk committees. So we're in a control assurance mindset. Unfortunately, I don't get to do a lot of risk taking in my big governance roles. I leave that for the startups. But if you look at this, you have a permission to play. You've got to be really good at the bottom three, compliance, financial, operational. And if you're good at those, you get to play in the strategic space. But you need to do it.
Just to make sure that your slide is still on the one that showing us what type of risk function do you want. You meant to put that on that slide, or is it already moving?
All right. What's coming up for you now?
It is now what type of risk functions do you want?
I'm just gonna stop this presentation, and I'll restart. All right, is that back up?
Yes, now it's your result, sample only.
Great, I'll go back one. So thank you very much for that. I was moving at pace. So the risk function roles, I think I took you through. I'm not sure everyone saw this. So the bold boxes, or the bold headings, were the ones that people thought were a priority. The amber ones were the ones where people thought, across the board, there was work to be done to meet expectation. And then this one here was, just as I ran through, that these varied in every organisation. So this one had particular areas of focus. They're very different to a lot of others, but areas they thought they were doing well. So in terms of your maturity strategy and your plan for the next 3 years, very important to get those clear and see whether your stakeholders agree with you, and also maybe get a bit of a technical review to make sure that those things are as good as you think they are. So then moving on to permission to play. So hopefully you're seeing a triangle with 4 blue boxes, coloured boxes. But just going back to David's presentation, I think David might talk during Q&A about taking risks in financial, strategic, operational. And so that's value creation. For the sake of today, I'm taking the view on strategic, operational, financial compliance as risks to be managed, to manage the downside. So that you need to do both, and you can't do both concurrently. They're slightly different conversations, but you need to do both. You've got to earn permission to be in the strategic space, and there's a particular profile to do that. People will have seen this, I hope. This comes from Corporate Executive Board, which became Gartner some time ago. And what they said back then, and this is the decade from 98 to 2009, they said, look, yes, you have risk issues in operational, legal, compliance, financial, But the things that really destroy or move your share price and do stuff with market capital that are sustained beyond a 2-year horizon are in the strategic risk space. We've done studies in Australia. We've got a slightly different market. It's even more pronounced here. If you have a reputational blip, you'll normally get that back within a few years. If you have a strategic mistake, you'll never get it back.
Excuse me again, Todd.
Yeah.
I think your screen's still not moving. I think you already talked about the next slides.
Okay, thank you. Let me know if this is any better. So is that now coming up? It should be a chart.
Okay, now, yeah, I can see where the action happened.
Great, thank you. So strategic risks. And just let me know if this one comes up. It should be 4 boxes and a couple of columns. Is that coming through okay?
Yep. Probably we
Yeah.
missed the previous slide. You can show us a little bit about the strategic, operational, financial, and the compliance.
Yes, so I might go to that. So hopefully you're getting a shrunk down version in a few columns. The key message here, though, is that in the updated data from Gartner, the latest round, 2015, it's moved from 68% to 86% of share value impacted. But if you look where audit and risk teams spend their time, 6%. Now, there's a question there about permission set and focus. And what we also know is it takes a lot of work and effort to manage the bottom parts of that pyramid. But there is a question about focus. And again, going back to risk seeking and risk control, for me, it's about what's amber and what's moving. In a fairly simple construct, and it's good to join the dots, literally in this kind of format. But, what are the green things that we think we're managing well that are principal risks that are material to us that we think we've got well controlled? You can send them to the audit team for a bit of comfort and to say, well, is that true? And with the amber ones, it's, well, okay, let's do something interesting. Do we take risks? Do we do something different? The interesting thing about strategic risks, of course, is that the only way to manage a strategic risk is to take risk. The other categories you can control and manage, but strategic risk, you got to do big and bold things. So then just to bring it home, just for Q&A. So key messages here for anyone setting the future direction of a risk. So whether that's you as sponsor hiring for a CRO or shaping the direction for the next 3 years. Before we get into measuring effectiveness, which I think we'll do after the break, focus is got to be really important. So, are you clear on what's important? Does your performance match your priorities? Do your stakeholders agree? And are you sure? And I would encourage you just to, I think this video is available. I would watch David's presentation and his timeline again, because if you're in that kind of context, then you're probably thinking about the right things. If you're not near that context, then it's probably time for a look. I think David's mentioned there's resources at DCRO that will be on the CRMS website. And if people want to access this diagnostic, I'll make sure there's something available for people on the website too. That concludes my remarks. I'm happy now to go to Q&A, but thank you so much for listening and for the opportunity to present. I know you're busy, and thanks for taking the time.
Okay, thank you very much, Mr. Todd Davies, for your clear presentations. But unfortunately, we can see maybe only 4 slides of your 12, actually your 12 slides. But what we can see over here was only 4 slides. Yeah, but your explanations already tells everything. Yeah, but still, if there's any questions from the participants, I want to take a look from here. Okay, any participants? Do you have any questions for our extraordinary speakers today? You can write it down in the questions and answer. Yeah, but
there is one question actually in the Q&A section from Titania, Pak.
Oh, okay. Let me see. Oh, okay. From Ibu Titania. Okay, so let me read the questions. I know that you can also read the questions, yeah, but I'm gonna read it for everyone. Tanya is from the fresh graduate from PPM School of Management. Yeah, any panelists can answer this. Good. Yeah. Good morning from Indonesia. My name is Titania. I'm fresh graduate from PPM School. I want to ask, the currently Indonesia is one of the highest. Okay, the question is, yeah, I want to ask that currently Indonesia is one of the highest corruptions country in the world, and the most of the corruption came from the leader attitude, who using their knowledge and skills to do such thing. Yeah. Do you think, yeah, that a company could auditing their leader's attitude? If so, when do you think it's the right time to do it? And probably I can ask, how? Please, David, Todd, yeah, probably I can give you each of you time to answer this half questions.
David, do you want to take this one?
So you can tell we're both jumping at this one.
Yeah, look, I'll have a go at it if you like.
Yeah, please.
There's a whole, it's interesting down here. We used to talk about non-financial risk, which meant traditionally operational risk. That's what it meant here. And these days that's morphed into operational plus conduct, and conduct is really behaviour. And so there is a whole stream of discipline. Interesting enough, one of the gurus on kind of culture and conduct risk, I think, might be in the audience today. But we've had a whole bunch of conduct issues here in a way that we think is unacceptable. In the way that we think about things. So there is I think with kind of conduct and corruption, we have a pretty high view of ourselves in terms of how we like to see ourselves. And then occasionally things happen that are very different from that view. And when those things happen, sometimes they're in the public domain. So this is a very hot issue here right now. And it's pretty much the issue, for the last couple of years. The old line here is that culture eats strategy for breakfast. I'd go further, culture eats everything for breakfast. And so, boards, what they're being asked to do now in terms of risk culture is define what risk culture they want, define what conduct culture they want, demonstrate to regulators how they're going to measure it and how they will know. So, all the committees I'm on, we get surveys, and it's things like, do you see this kind of behaviour? Do you think you can speak out when it happens? Have you spoken out when it happens? Did you get a result? That sort of thing. So it's speaking up safely is a big thing. We see misconduct in hospital environments, and there are a lot of parallels. If you see something, say something. And if you say something, you want to make sure that you're heard. So that's where we are with it. Whether it's auditing the boss and kind of waving your finger at them, I don't know that achieves the result, but it's definitely a work in progress here, and there is a lot happening on it.
And I think one thing I'll just add to what Todd had said was, I remember more than 20 years ago, and I could be wrong in this, but I have a fairly strong recollection of it, that in global corruption indices around governance, back at that time, Indonesia ranked among the bottom 2 or 3, meaning among the worst in the world. And I suppose it doesn't matter who is the worst when you're down in that territory. But more recently, as I've looked at it, Indonesia ranks solidly in the middle. Now, you might have aspirations beyond that. I hope you have aspirations beyond that. I think Anton and I, when we've talked about why his organization exists, it's to progress and continue to move up those ranks. And what I will say to you is that the cost of capital is a function of the trust that people have in you. Now, you've moved from worst to the middle, which means now move from middle to the top, or top third, top quarter, whatever it might be. And part of that's generational. And I think the person who'd asked this question mentioned that they were just out of school. That's great. I have a daughter who's 18. I have a son who's 21. They view the world in a very different way than we did when I was their age. So I think the progression will continue. So I'm not trying to say sit back and wait until the generations pass, but know that there have been improvements, continue to put the pressure on, but also sell it as a benefit. And when you can start convincing people that the cost of running their business goes down when they have higher levels of integrity, then maybe you'll get more people to come that way. I don't know how you quiz them on that. I can't imagine being in my 20s and asking the CEO for an evaluation of whether he or she is corrupt.
Yeah. Actually, David, do you mind if I segue briefly back to something I wanted to touch on? So pension funds are really big in this part of the world. Norway and here, I think we've got the largest retirement savings on a program per capita anywhere in the world. We have this, 10% of your wages go into retirement funds of every pay cycle. And so we have a situation here where shareholders aren't necessarily just owned by mums and dads, they're owned by pension funds. And so pension funds have this view, they own the entire index. And therefore, if there's bad behavior or value destruction where there's win-loss, then the pension fund loses. And so for the last 20 years ago, I guess, ESG funds have lent in heavily on conduct issues with boards to say, well, what are you doing about conduct? Or we're not happy with your behavior on this. And so the shareholders, they're moving the capital. In this market, we've had 2 states where the pension funds have said, we will not debt fund you because we don't like your carbon emissions profile and your climate risk profile. So we're just not going to fund you. And so equity funding is important, debt funding is more important. And so, we've been in this terrible political impasse, about moving on climate, but actually it's the weight of capital that's now moving it. And you're getting conservatives being very progressive now on climate change in these parts of the world through capital. So I think that's interesting. It just underscores the point that David made in his presentation. If your reputation's great and your risk profile is low, people will want to give you money and come to you. If you're poor reputation and if you're poor risk management, then people will avoid you. And so, that's the payoff.
Todd, I think you had mentioned a little bit earlier about ESG. And one of the things I didn't put on my timeline because it's a failure, nobody wants to talk about failure, but is back in 2009, I had launched a company called the Governance Fund. And I met with several hundred potential allocators to put money into this fund, which was based on identifying well-governed companies and differentiating them from the poorly governed companies and generating a positive investment return. And I will tell you that, I had a conversation with someone who is at one of the largest asset managers in the world, who at that time said to me, we would never invest in something like this. And I will tell you that that same company today is one of the largest advocates for governance and sustainability in ESG in the world. And the assets back then in this were tiny, and now they're in the trillions. So the capital is flowing towards the things that the question was asked about. The capital is flowing towards sustainability, governance, environmental responsibility, all the things that stakeholders want when they provide us with their capital. So the trend is all going the right way.
Okay, thank you very much for the clear answer, David and Todd. I'm going to the next questions because we have already some questions in here. Yeah, it's from Wichitra. Yeah, the question is, what do you think is the most critical character or trait that a CRO should possess? You can start with Todd. You can start to answer. The question is for
I got in trouble because I gave a response to this a few years back, and off the cuff I said, whatever you do, don't recruit anyone with a risk background. If you're a CRO, these are leadership roles, and it's a bit flippant, but it is kind of true. You want people who are very much commercially oriented, eyes on the prize, thinking about the things that the board members are thinking about, which means they're thinking like an owner, they're thinking like a director, they're thinking like a chief executive, and they can hold those kind of conversations and then bend the risk team really to fit that. So my view, that's it. The other thing I quipped is, the modern CRO with a change journey is, 30% vision, 30% sales, 30% change management, and bringing people along, and maybe 10% technical to help the team work within that. So that's my view. That's kind of the profile that I recruit for. But the thing that strikes me, I think, is the people that come up within the risk areas are great. But the people who are quite often outsiders who know very little about risk are often better. And it's just because they have this view from the customer perspective of what they need to do, and their intuition is just bang on. So, you know, I don't think there's any right thing, but, you know, for me, going back to the model I presented earlier, you know, there's 16 attributes. And if you want a CRO that's just going to go and be a compliance person and hit people over the head, that's a profile. If you want to have someone who does the stuff that David talked about, very different profile. And I'd like to think I was kind of that David profile, you know, during my time, and that I've never lost faith in that. Regulators sometimes push you away from that because, you know, short-term pain is something to be managed.
Yes, of course, it's much easier to judge, to measure people from their skill, experience, and competency rather than the character, right, Todd? Because this is something that I don't know how to measure the character. But okay, David, please. I know you already have some answers behind it.
Yeah, no, I thought when Anton was presenting Norman Mark's bullet points, I thought those were all pretty good. Todd, I think it talked about leadership, essential, understanding that a business exists to take risk, essential, having the ability to stand up to powerful people, that's essential, having the ability to empower smart people to take risk and to monitor risk, that's essential, have great communication skills, that's essential. I will tell you that every characteristic of a good chief risk officer is also what you'd find in a good chief executive officer, with the exception that chief risk officers tend to think in a way that I describe as stochastically. So they tend to see the world as having myriad possible outcomes. And so and it's happened in a couple of places, but honestly, I think there are very few people who understand a business as well as the CEO does, except for the chief risk officer, who may understand it almost as well. A good chief risk officer. So they're not focused on compliance, they're not focused on regulations, although that's part of it. They're focused on how the business succeeds.
Okay, thank you very much, David and Todd, for your right answer. Yeah. Okay, I'm going to the next questions. It's from Pak Rahmadi Kustrian, yeah, from the Pelindo. As we all know, just recently, Lara Warner, the group's chief risk and compliance officer, and Brian Chin, head of investment bank, are set to depart, Credit Suisse said on Tuesday. Warner's removal was first reported by the Financial Times. Yeah. The question is it CRO's responsibility to what happened with Credit Suisse? Please share your valuable thought. Who wants to start?
I think in the old days, that was one of the biggest problems with risk managers focusing on loss, is that it also gave the business a way to use them as a scapegoat and say that when there's a problem, the risk officer should have stopped it. Those days, for the most part, are gone. None of us right now know everything that went on in those offices. I don't know if we'll know with certainty until there's litigation and discovery and whatever else happens over the next 5 years as people sort this out. So I don't want to impugn anybody who was involved, but I do remember when I read that she was being replaced. This is the group chief risk and compliance officer. I remember looking on LinkedIn to see if we knew each other, and we're not connected. But the other reaction that I had was this title, Group Chief Risk and Compliance Officer. To me, that sends the wrong signal about risk. If that's what the board wanted, if that's what management wanted, that role should be compliance focused, then they're going to wind up getting losses in some form of risk. So again, we don't know. I don't know. I'm not in that situation. So again, I don't want to impugn anyone in this story as it unfolds. But if someone was to tell me that their chief risk officer was primarily a compliance person, I would tell them you're likely to have a problem at some point in the future.
Okay. Thank you, David. Todd?
I'm not across the specifics of this one at all, but I've seen many cases that might be similar. It boils down to what do you want the chief risk officer to do? And if you want the the chief risk officer to sweat bullets on every risk class and to give the board and CEO comfort that everything is under control and well contained, and they give that assurance, that's a particular profile. If it is enabling the business and those people close to the source of risk to own their risk and make commercial decisions and trade-offs as an enabler rather than as a controller, again, a very different profile. I've definitely seen chief risk officers thrown under the bus for the sins of management in the same way that happens with auditors. And I guess my counsel is for people in those roles, make it really clear what you're on the hook for and what you're not on the hook for, and just manage that well. And if there's an expectation gap that's unreasonable, have your resignation in your top pocket and for the hard conversation. And, I do this on audit committees all the time because the ones I'm involved with in government, we're not separate from the board, we're part of management, advising into management and the chief executive. And I often have the hard conversations of, this isn't really giving me the comfort that I want or that you need. Maybe there's not a fit here. If you want someone tick box, I'm sure you can find someone, but it ain't me. So, you've got to have those conversations time to time. A lot of chief risk officers end up out of work temporarily when those tough conversations are had and there isn't alignment. So you've got to get that alignment happening on the way through and when they appoint you.
Okay, thank you, Todd.
Occupational hazard, I think, occasionally with these kind of roles.
Okay. So my question then, it's just my questions here. To what extent is actually the responsibilities of CRO to the success or to the failure of the company? Because we know, there's the top responsibility is going to be on the CEO. When you talk about money, it's going to the CFO. When you talk about the operational, it's going to goes to the COO. Yeah. But which part of the CRO's contributions, to the success of a company that we can see probably right away, instantly during the business? Probably David can answer first.
No, I'm happy to. So from a board perspective, the chief risk officer is the CEO. So let's just say that that's the one direct report that most boards have. So it does the success of the organization in the board's view, or failure resides there, unless the board hasn't been clear about strategy and the rules for pursuing strategic objectives, because it might be the board's fault too. When you get into the organization, a good chief risk officer in some cases has a dotted line or maybe a direct reporting up to the board, depending on what the local regulations are. And so they may take on a different amount of responsibility. But what I would say is it's like anybody else in the C-suite, they have a job to do to help support the organization at best achieving its mission. So this chief risk officer is also responsible for the success of the organization. And as I said, I think they're as close to understanding what goes on in the organization as anybody in comparison to the chief executive officer. So the question would be, as I think would be the case of a chief executive officer of anyone in the C-suite, are you providing me with decisions and information that help me make better decisions for the organization? And if you're not, then you're responsible for it not doing as well as it could. So I think it's like anyone else in the C-suite. It's just a different realm of responsibility. But the temptation, as Todd had said, is there to throw somebody under a bus when there's a loss. I think most boards are getting smarter than that.
Okay.
We remain hopeful, David. We remain hopeful.
I'll retire in a few years, and I'm hopeful that that's the case by the time I retire.
Look, I might just share an anecdote. Here during the global financial crisis, the risk teams in Australia, at least, I think we've lost David. Hopefully we get him back. But the risk teams in Australia, at least, said, we're not responsible for these risks. We just do the reporting.
Yeah.
So not our problem, So, but a bit of a cop out because the world was going, crazy at that point in time, and boards needed more than that. Interesting enough, the auditors who are much closer to the board said, well, that's unacceptable, so we'll step in. And so for a brief period of time, the audit kind of cohort, who were pretty strategic, a bunch of us kind of got hired and fired, and there was a cohort of us that had some capability. We all stepped in. And so there was that period of time. On a contrasting scenario, there's a great CRO who kind of travels the world fixing up investment organisations. She has a classic line, which is, you're outside of risk appetite on your facility, so you can close that out and that deal you've done, or I'll come back this afternoon and I will do it. Now, that's a decision-making process. That's very different to a facilitated process. And so the question is, what type of CRO do you need? For what type of risk classes do you have? And then shape it to fit. I think then you can do the maturity model, but you've got to do that pre-step. What do you want these people to do? Get some role clarity, in my view.
All the things Todd has been talking about are things that I can think back to the first 20 years of my career having happened. So he's not just pontificating. Those are all very real situations.
Okay. I still have some questions over here, but the time is up, so I'm very sorry. Yeah, but it's very interesting conversations. I've learned a lot from this, from your guys' presentations. Yeah, from the history of how the actually risk management and the CRO was began, and also the change of perceptions about risk. Yeah, starting from David's presentations. Yeah, how wrong can you go? Until then you realize there's management is not only talking about how wrong can you go, but also realizing how you can achieve your objectives. Yeah, and also from talking about how to measure what do you need in a company, in your organizations. Yeah, probably through some measurement, sometimes also called as a risk maturity. It's very important for managing the life cycle of the organizations. So I thank you a lot, for David Koenig and Todd Davies. Please give our big applause. I know that we cannot hear, but yeah, it's only me that hear.
you.
But it was very amazing to be with you guys. Thank you very much.
Fajar, nice to be with you. And thank you, Todd. Good to see you.
Likewise, take care.
Okay, thank you, Todd Davies and David Koenig. Very, very interesting insights as always. Thank you very much once again for taking your time out of your, we know your very busy schedule, but thank you very much once again. We really appreciate it. Okay, ladies and gentlemen, so we will now have a 5 minutes break before we continue to the second panel discussion. Don't go anywhere because we will have Mrs. Linawati Wijaya. She is the Chief Risk Officer of Manulife Life Insurance Indonesia, and also Mr. Suryo Rimbo Suroto, the Head of Risk and Governance at PT Jakarta Propertindo. So ladies and gentlemen, see you again in 5 minutes. Thank you very much. Thank you, David. Thank you, Todd.
Thank you, Nita. Good to see you.
Thank you.
Very good, David. Todd.
All right, welcome back, ladies and gentlemen. Mr. Proboseno, are you here? Pak Fajar, okay. All right. So, ladies and gentlemen, we will now start our second panel discussion session for today. So the panelists will be Mr. Suryarimba Suroto. He is Head of Risk and Governance at PT Jakarta Propertindo. And also Mrs. Linawati Wijaya. She is Chief Risk Officer of Manulife Life Insurance Indonesia. Again, to lead this panel discussion, I will invite Mr. Proboseno. So please, Mr. Proboseno, the screen is yours.
Okay, thank you, Nita. So let me introduce right away to our distinguished speakers for today. Mr. Suryarimba Suroto is, of course, certified professional for training, also assessors, for risk management in particular. Currently, he's the head of governance and risk management in PT Jakarta Propertindo, Zero Daerah, in Jakarta, DKI. His role is to ensure that risk and compliance management is built, integrated with the policy and processes, and contribute values, to JAKPRO sustainability, growth, and culture. He's also the project leader and management representative of Jakarta Propertindo's anti-bribery management system, the ISO 37001. While building the maturity of good corporate governance and also establishing Jakarta Propertindo's whistleblowing system and initiated improvement in the business process throughout the company. And the second speaker for our second session is Ibu Linawati Wijaya, is the Chief Risk Officer for Asuransi Jiwa Manulife Indonesia, with more than 20 years of experience in life insurance industry. She possesses a deep knowledge with hands-on experience in controllership and finance, both local and IFRS. Besides, also knowledgeable in Indonesian taxes, law, and tax dispute mechanism. Also, she has the ability to combine strong business acumen with effective management skills. Mrs. Wijaya is also adept on implementing innovative practice and procedures to improve efficiency, customer experience, and increasing shareholder values. Also contributes to the Indonesia Life Insurance Associations in AAJI, tax working group. So for the next sessions, I'm not going to take further time. I will call Mr. Suryarimba Suroto to give the presentations. Please, Mr. Suryarimba, the screen is yours.
Thank you, Pak Fajar. Good morning, everyone. And also perhaps good afternoon to Todd. And I think that David is already in the evening now. Is it, David? Thank you for having me. Today, I got around 20 minutes. I will share my experience and what we've been doing in my company, Jakarta Propertindo, which is a local government-owned company, owned by the local government, the state of DKI Jakarta. I will share my presentation to you. Sorry, excuse me. Chitra, can you help me, Chitra? I think I have a problem in presenting my slides. Okay, next to the other slide. Okay, okay, I'll take control. Okay, this is a bit about me. I will skip it. Hold on a second. Okay, Okay, first I would like to share and explain the role and function of the regionally owned enterprise, which is in Indonesia we call it Badan Usaha Milik Daerah. The regionally owned enterprise is a company established by the local government, which equity in majority or a whole owned by the local government. And the objective of this enterprise is to develop and explore potential economy in its region. And there is a regulation for the establishment of the BUMD, Badan Usaha Milik Negara. It is from the Undang-Undang number 23, which is established in the 2014. And also there is another peraturan pemerintah number 54 in 2017. And okay, the next slide. Oh, excuse me, I think. Oh, okay, first. I would like to introduce you with the DKI Jakarta vision and mission. As some of you here perhaps are living in DKI Jakarta, and DKI Jakarta as a local government, they have a vision to make Jakarta a more developed, sustainable, and cultured city whose citizens are involved in realizing civilization, justice, and prosperity for all. And based on this vision of the DKI Jakarta, my company, and in fact, all BUMD in Jakarta, our main responsibility and our main role is to support and help the local government, DKI Jakarta, in achieving their vision. Some of us are in the banking sector or in transportation sector. And in my case, my company, the Jakarta Propertindo, currently is handling the infrastructure, property, ICT, and also utilities. So it is quite a challenge, knowing that what the local government, which is our main shareholder, expect from us. They have very high expectation. And as you can see on the screen, that the company Jakarta Propertindo Perseroda has been quite a while in this country. At first, the company exists as part of the DKI Jakarta around in the 60s or the 70s, but it became it was established as a independent entity starting in 1985. And starting from 2000, officially as the PT Jakarta Propertindo. So one of our mission is to become an excellence company to make Jakarta better. Well, basically, our vision is to, like I mentioned earlier, our vision is to help to support our main stakeholder, the Provinsi DKI Jakarta, to achieve their vision. And on the screen, you can see that some of the projects assigned by the government of DKI Jakarta currently, at this moment, my company is handling stadium, the Jakarta International Stadium, which is scheduled to be completed this year. At the end of 2021, it will be the largest football stadium in Indonesia, larger than the Gelora Bung Karno. Currently, my company is also assigned to revitalization of the Taman Ismail Marzuki. Perhaps some of you who live long enough in DKI Jakarta knows that there is a center of art and culture in Central Jakarta called the Taman Ismail Marzuki. Currently, my company is assigned by the government to enhance, to revitalize the Taman Ismail Marzuki to become a world-class art and culture center in Jakarta and hopefully in Indonesia. Currently, JAKPRO, as we usually call it, JAKPRO also handles the LRT Jakarta, the light rail transportation. Currently in Jakarta, there are 2 LRTs. One is the LRT Jabodebek, Jakarta Bogor, Depok Bekasi, which you may recognize whenever you drive through the toll road. That is from another company. The LRT that my company is handling is in the central Jakarta, and currently it's in the eastern Jakarta, near Kelapa Gading. And there is another assignment, the velodrome. It is for the cyclists. It was prepared for the Asian Games in 2018, and there is another intermediate treatment facility. That is the latest assignment from the government of DKI Jakarta, so we can. The intermediate treatment facility is scheduled to operate in 2024. There will be 4 ITFs in Indonesia, in Jakarta, and my company will handle 2 ITFs. So these 5 project assignments from the government DKI Jakarta, as you can see, it's very challenging. Using very high technology involves international contractors, and it also involves a very huge amount of fund. It's more than trillion rupiahs. So, and what we've been doing, like I said earlier in the beginning, what we've been doing is to help the DKI Jakarta to serve the people of DKI Jakarta. And as you can see, these projects are very challenging and also arise very serious risk. In the following year, since the project assignment was initiated, the company, it's been, I think, around 5 or 6 years since the initial assignment from all 5 projects here. We try very hard to understand, in our case, the risk, because all of these are very new for us. Okay, especially for the BUMD, state, the local government-owned enterprise, there are requirements for implementing GRC, the government's risk and compliance. So at this moment, I already identified 2. First is the government regulation number 54, 2017. And in that government regulation, there is a mandatory that all local government enterprise should implement good corporate governance. And there is another regulation. This is from the governor of DKI Jakarta, which may vary among other local governments. But the DKI Jakarta governor, they made a regulation in 2019 that every business plan and budgeting must implement risk-based business plan and budgeting. So risk and also opportunity and also compliance should be considered whenever we make a business plan and budgeting in every year. So, well, basically in the last 6 years, I think. In the last 6 years, JACPRO, the company I work for, JACPRO, we are implementing all of these, risk management, compliance management, good corporate governance, quality management, and everything. And the latest one are safety and also the anti-bribery management system. So currently, currently our organization structure is like this. It is interesting that earlier this morning that we heard the presentation from David and Todd talking about chief risk officer. Well, actually, truthfully, in JACPRO, we don't have chief risk officer. What we do have, we have 5 directors instead of the well, we have recently we have 5. We have additional 1 directors. First is the president director, of course, and then there is a financial director, business development director, asset management director, and the last one is the human capital and the general affairs directors. Well, this is the latest board of directors. Until last year or early this year, we only have 4, and now we have 5. Besides the 5, the board of directors, there are 2 special assignments. One is the trustee director for the good corporate governance. It is appointed to the finance director, and one of the main responsibility of the trustee director for GCG, good corporate governance, is to promote good corporate governance as part of the government regulation, as I mentioned in the earlier slide, and also to ensure that all good corporate governance principles are implemented in the company. Well, this is not easy. I have to say that. Well, in the past, I think the trustee director for good corporate governance was established in 2016, I think, or 2017. Well, before that, well, nobody, well, no, the directors are no special assignment to handle the good corporate governance or to ensure that we comply or we fulfill the requirements of the standard. Currently, we are adopting the standard for the BUMN. BUMN is a nation state-owned enterprise. And other than the trustee director of good corporate governance, we have a head of anti-bribery compliance function. It is also required by the ISO 37001, which we acquired in November last year. The head of the anti-bribery compliance function is director level, which is currently the human capital and the general affairs director. So currently, there are 2 special assignments to the director. And fortunately, me as the head of governance and risk management, I currently have 3 directors to report to. First, I report to the president director, which is my direct supervisor, and then for good corporate governance, risk and compliance, I also report to the trustee director of the GCG, which is the finance director. And for the anti-bribery, which is currently I'm also the management representative, of the anti-bribery management system, I also report to the human capital and general affairs directors. So I know that in my company, we don't have a chief risk officer, but in my experience, all directors, currently 5 directors and also 2 special assignments to the 2 directors, we try our best to manage the risk. I noticed that in the earlier presentation, Pak Antonius Alijoyo mentioned around 20 roles that the chief risk officer should have. I try to understand each one of them, and I think that perhaps not 100%, but in some level, some of the roles are handled by the current directors in Jakarta Propertindo, and also handled by the 2 special assignments to the directors, which is the trustee director for the good corporate governance and also the anti-bribery compliance function. So, well, yes.
Just to remind you, your time still have.
Okay. Okay, I will make it quick. Well, what we've been doing to support the BOD in terms of risk and compliance, that currently one of my main jobs is to assist, and also to help each director to have a good understanding on risk and compliance, help them to implement them in daily decisions, and also acknowledge the consequences if not paying enough attention. So basically, it is more like an advisor. The second, what I've been doing is to ensure that every decision in the company is supported by analysis, data, risk, and compliance assessment, and also along with other considerations. Well, this is, in fact, this is still a never-ending journey, a never-ending effort for me to ensure that every decision is based on risk and compliance. And also updating the directors with current regulations and also changes in internal and external context to make sure that the directors acknowledge that how any changes may affect our business, and also a continual improvement in everything, policies, procedures, frameworks, and also many things. Well, it's still a long journey, my dearest friends. So maybe the question is, do we need a chief risk officer? Well, in my opinion, I think that JACPRO, well, it depends. Like what David said, it depends on the needs and expectation, not only from the board of directors, but also from the shareholders. I know that some of the CRO roles are implemented now, handled by the existing directors, but I think maybe in some level one day JACPRO need a chief risk officer, and I know that in one of the participants here today, is a representative or our shareholder. I know that person very well, and I know that our session today will give a very good knowledge for the future of the company. So that is my presentation, Pak Fajar. The rest is the whistleblowing system in case somebody wants to report fraud or report breach in code of conduct. And that is the last of my presentation. I hope that my presentation answers many of your questions or where we are maybe today, Badan Usaha Milik Negara, where we are today. Are we good enough in implementing risk? That is always a question for me every day. And feel free, anyone, if you want to ask questions, I will be gladly to try my best to answer each one of you. Thank you very much.
Thank you very much, Pak Suryo Rimba Suroto. It's enlightening presentations. Yeah. So we know that actually the CRO has so many things to be done, whether we need it or not. I don't know whether it's going to be decisions of everyone. Yes, indeed, it answers lots of questions and also raise more questions to you later. Yeah. So any participant who has questions to Pak Suryo Rimba Suroto, just write it down in question and answer, because we are going to our next distinguished speaker, Ibu Linawati Wijaya, who is already here, ready to present. So not going to go far. Please, Bu Linawati Wijaya, the screen is yours.
Yeah. Okay. Hi, everyone. Good afternoon. Thank you for your time. Actually, I am Linawati. Actually, I'm CRO for Manulife Indonesia. Manulife Indonesia is the insurance company. However, we also have other business unit, which is like pension, and also we have subsidiaries like asset management. But our main business is insurance company. Actually, I've been working with Manulife for more than 20 years. However, for the CRO role, actually, I have been working for more than 1 year so far. And today I don't have the presentation, the deck, but I want to share about the CRO role. How is the CRO role in Manulife Indonesia? And also actually for CRO role in Manulife Indonesia, for the globally, we have the CRO role across the organization. Every country we have the CRO position so far. And today actually, I'm trying to align my sharing session with the presentation deck from Pak Anton, and today I will explain and give like the actual practice how to as the CRO role. Okay, I will start with what is the role for CRO. Actually, first of all, for sure we need to promote about the risk culture and risk awareness across the company. I think this is a very important role for the CRO, particularly how we maintain communication across the company, particularly with the senior management teams and also other stakeholders with the commissioner. And if you have like a regional office and also a global, you need to maintain with those stakeholders as well. And other than that, we also need to maintain the communication on the middle management, because what I saw here that the middle management has the important role to ask for to have a good risk culture across the company. How we measure that whether our company have like the risk culture, good risk culture or not? I think some of the company usually in Manulife we have like the risk culture index every year, and if your company you don't have,
I'm sorry. Have you share your screen?
No. I don't. As mentioned, I don't have the slide deck to share. This is I'm sharing is about the best practice what I'm doing now, Pak Fajar.
Oh, okay. Okay. Thank you.
Yeah. Yeah, I think I can share about the best practice. Certain item that you can do for as the CRO role later on. I think I can collaborate with Nita if you need for the summary of my sharing session, Pak Fajar.
Sure.
And then, yeah, I think the second item is about the risk culture index. If you don't have the annual survey, you can conduct a mini survey and review the result, and also verbatim from all employees and also including from the senior management. I think this is the best practice or action that you can do, how to measure whether you have the good culture risk index or not. Something this is a very useful for us and to set up like the action plan to promote risk culture. What is the risk culture itself? I think Pak Anton also already mentioned before how the employee want to speak up if any incident or if any if any things that not comply with the company policy, and how we improving our control and so on. Other than that, I think we also have need to have risk management training for new employees. I think this is the important things as well, to make sure that every new joiner in the company will get the risk management framework information after they join the company. Yeah, I think this is the certain action items for to promote the risk culture in the across the company. And the second one that I would like to share, how we provide oversight of risk management policies, process, and system to facilitate our business and company framework, and also as well as the regulatory requirements. And we need to collaborate with other business unit and also functional to identify, measure, and to measure our control, whether it's in line with the risk exposure, whether it's managed within our risk appetite and action plan, whether the action plan is actionable, and also follow up. One thing that I would like to mention in here, that as CRO, you need to have very deep understanding about the business process, which is end-to-end process. To understand about the end-to-end process is really important, because by having that knowledge, you can identify the key risks amongst the organization. What I mean in here, not only the key risks from the internal organization, but also is there any external risk that impact to our company? It depends on the nature of your company. What is the regulation, market, and other things that you think that will impact to your strategic deliverable for your strategic and so on. I think this is very important for CRO role to have to understand about the business process. As mentioned before, that we need really to collaborate the business unit. How we collaborate with the business unit? We can have risk champion in the risk its department. Maybe the risk champion you can have for its division, you can have one risk champion. But if you consider for the one division is very big organization, you can have more than one risk champion. Yeah, other than that, we also need to set up key risk indicator for each division. And again, if the division is very big, so you need to set up more granular level for the key risk indicator. And the last one, I also mentioned about the control. We need to do the regular control, particularly when we determine for one key risk indicator is red or amber, what is the rating of its key risk indicator across the company. You need to have the regular and strong monitoring process to make sure that you have the action plan, which is the action plan this is the real action plan and based on the outcome, and we go to achieve the path to green, which is we need to change the risk rating from red gradually to amber and gradually to green. I think this is the practice that you need to have, and yeah, part of the CRO to have the strong controls across the company. I think this is the other things. The third one, I think the company has the overall strategic plan. And I think as CRO, you have to get the access to know what is the overall strategic plan. I think it's really important for all of you to discuss and also to get the overall strategic plan and also to understand the overall strategic plan for the medium term and also long term. And then you need to identify what is the key risk and also what is the mitigation of the each key risk. I think this is the important for us to understand from the execution. How is the execution of the strategic plan? How is the business model from the operational side, from the talent? And also, is there any concentration risk on our initiative going forward? We can identify from the market. Is there any market concentration, regulatory concentration? And again, because of now we go for the digitalization, which is we need to also concern on technology and how is our technology, how is the current infrastructure may not be able to fully support our strategic plan going forward. Yeah, other than that, I think as CRO, you also need to understand about the product and other external factors, as I mentioned before. Is there any external factor that can impact to our strategic going forward? So I give the real example, maybe for Manulife, the external factor, we need to monitor about the interest rate because our product also, the interest rate will impact to our product going forward. Yeah, this is the one that one of the CRO role as well. You need to understand about the external factor. I think, yeah, this is the other things that the fourth item that I would like to share as well. Not only the existing risk, as I mentioned before, about the risk culture, about the business process, and what is the factor that will impact to overall strategic plan. But as CRO, you also need to support and also to understand about the evolving risks amongst the company and how we get the evolving risk for each division. You need to set up like discussion with each division because we need to get like more information from the each division. What is the evolving risk going forward will impact to company? Yeah, I think this is we as CRO we should aware as well. We can mitigate and also set up the action plan before to be a risk for our company. This is, yeah, again, for Manulife, the example, we also consider if any changes on the interest rate, not only for Indonesia, is there any changes in the, say, the economic in China? Is there any impact to our company or not? Yeah, something like that we need to discuss more, and to have more discussion with certain stakeholders. Yeah, I think this is the the practical things that I would like to share so far, Pak Fajar. Yeah, other than that, I think we also need to satisfy the local board and also regulatory requirements around the risk governance, and also, yeah, including how to influence the regulatory and also industry risk framework changes. Yeah, I think this is the key items that I would like to share today, Pak Fajar.
Okay, thank you very much, Ibu Linawati Wijaya, for sharing the functions of the CRO, yeah, particularly in Manulife, yeah, as your company. Yeah, of course, it's very interesting to see it different side, different kind of business from
Yeah.
Yeah, in
Yeah,
particular.
I think another one that you need, as CRO, you need to make sure that risk management embedded in the every initiative. The example, if you have like the project plan or the product development plan, you need to make sure that risk, yeah, not only for for like the enterprise risk management, but also for the operational side. What is the risk that might incur going forward if we have this initiative and so on. Yeah, particularly I think every company now is trying to go for digitalization. I think we need to understand about that initiative as well. Yeah, I think this is my sharing today, Pak Fajar.
Yes, of course, Brina, and understanding that your business is also taking someone else's risks as a
Yeah.
risk. So it's going to be very interesting. Let us see over here. There's a question from Pak Mizanur Rahman. Let me read it. Yeah, I know Pak Suryo Rima already write it down, but I want Pak Suryo. Are you there? Yes, I'll read
Yes,
the
Pak Fajar, I'm still here.
Yeah, so we can share from both perspective. Yeah, from the local government company and also from insurance company. The question is from Pak Mizanur Rahman. Yeah, Pak Mizanur Rahman is from the NGO. Yeah, mainly cover all of the areas of risk and regulatory update, risk management committee, and the board of the organizations. The questions are: how do we effectively manage the risk management in mid-level and senior management? Of course, yeah, this area I know that's going to be the most difficult one, because the ones on the bottom usually easier to do. Yeah, but senior and mid level, yeah. And as these levels are this is there no this is that this is just an additional job. Yeah, I'm sure that's what Ms. Zanor means. Yeah, risk management is considered as an additional job. Yeah, but executive management are keen to implement the risk across the organizations. Yeah, yeah. So please share the answer. Probably Suryo Rimba Suroto can start. Yeah, because you have the jump start in the written. Ibu Linawanti can answer later.
Yeah.
Please.
Okay.
Pak Suryo.
Okay, Pak Fajar, Pak Mizanur, Mr. Mizanur. Well, I will share my experience in my company and how in doing this. I know the pain. I know the pain that you ask concerning the middle management are not buying in the risk management initiatives. So I will share you my experience, Pak Mizanur. So one of the first things that I did when I established the risk management manual, inside the manual, there is I mentioned the responsibility for each position in the company. This is very important, Pak Mizanur, because when if you remember the ISO 31000 leadership and commitment, usually people think that the leadership and commitment is for the board of directors. Well, that is very not true. That is very not true, because leadership and commitment falls to all positions in the company. Of course, Pak Mizanur, Pak Fajar, everyone in the company has their own role. For example, a role of the manager is very different from the general manager. A role for an officer is very different from the manager. And manager A is very different from manager B. But what we have to communicate and also what we have to establish in the manual is that risk is everyone's business. No matter who you are, no matter what functions you are, risk is always become part of your job, part of your duties. So that is why mentioning that in the risk management manual is important. And also, if you want to go further, you can collaborate with the human resource or the human capital division to ensure that in each position is each position's roles and responsibility or each position's job description, they have to mention that one of their main responsibility is handling or managing risk as part of their responsibility. And if you want to go any further, Mizano, you also can make a key performance indicator for each of them to ensure that middle management implement the risk management. So that is what I can share, Pak Fajar. I hope this enlighten the question, Pak Mizanur. Thank you.
Okay, thank you, Pak Suryorima. Ibu Lina Mati, would you share some thought for this question?
Yeah. Actually, this is, I think, this is about the tone of from the top about the commitment. I think as CRO, we need to, as mentioned, that we need to maintain the communication and also collaborate across the company, particularly for the senior management. How we do that? I think the first one, from the risk management, we need to have like the campaign plan, the action plan, how to promote the risk culture. And from the senior management will involve on the campaign. Usually we have some campaign in the company and we ask the board of directors to join our campaign, because the campaign, this is to show that as a tone of from the top. And other than that, I think how the middle management understand about the risk management, how is the risk management is not like additional job or other things, that we need to give them about the how useful risk management from their jobs, and how the risk management can very helpful for them to mitigate any risk, any issues, not by having that, they can mitigate if any issues going forward, and we need to give them more understanding about what is risk management. Therefore, we collaborate regularly with CRMS. I think CRMS is very good to provide certain topics that in the market, so the senior management, the middle management really understand about the culture of the company, that we really support about the implementation of risk management across the organization. I think this is one of the sustainability plan and also continuity plan, how we develop and also educate the risk about the risk management across the company, and also as well as about related stakeholders that impact to company. Yeah, I think this is the answer from my sharing, Pak Fajar.
Okay, thank you, Ibu Lina, for the sharing. Yeah, for the second questions, how do we measure risk management efficiently and effectively in any kind of organizations? Because we know that risk management, even from the ISO 31000 view, it cannot be certified. Yeah.
Mm.
I give some additional over there. Yeah, because it cannot be certified. So how do we make sure that the risk management implementation is already effective and efficient in our organizations? Please, Pak Suryo or Ibu Lina wants to
Oh,
start.
okay. I will also share my experience, Pak Fajar. One of the things that I did in the past is to measure the maturity of risk management implementation in my company. It is not very easy. It is definitely not easy, Pak Fajar. And but I think that measuring the maturity of risk management in a company is very important. So we know that how good we are, or how good the risk management principles are implemented in our company, in our system, in our business process, in our culture, in our technology, in our data, and in everything. I think that doing the maturity measurement is one of the very useful approach to do, Pak Mizanur. Yeah, perhaps we cannot do it alone, Pak Mizanur, if you don't have the resource. But I know that there are many experts in our country or in anywhere that they can help assist our organization in measuring our maturity level in risk management implementation. Thank you, Pak Fajar.
Okay, thank you, Pak Suryo Rimba. Ibu Linawati, would you please? You're still muted, Bu Lina. Can you unmute it first?
Okay, sorry.
Okay,
Yeah,
you.
I think I explained before that how we measure about the effectiveness of risk management. So we can do like to measure risk culture index. If you don't have risk culture index, you can prepare like the pulse survey to the amongst the company and see what is the result from the survey. Other than that, we also can check for the other indicators about the how many incidents that the company has so far, and how much the how many losses that incurred from those incidents. Yeah, it's I think this is one of indicators whether we have the effective risk management implementation amongst the company. Other than that, I think we also know that we have 3 lines of defense from first line, and we as the risk management as the second line, and we have also the third line from the internal audit. How many audit findings that each department has so far, whether they really has what is the audit result, whether unsatisfactory or requires improvement, and whether they really understand about the key control for its process and so on. I think we can use it some indicator for our reflection, and also as CRO we can use it as the reflection, and also to identify how effectiveness the risk management implementation across the company. Yeah, I think this is my thoughts on this, Pak Fajar.
Okay, thank you very much, Ibu Linawati and Pak Suryo Rimba. Pak Suryo was relating it to the maturity of risk management, yeah, and also Bu Lina relating it to some processes in the business, including internal audit. But actually, how can it show? Yeah, does it reflect probably from the maturity of risk when the number of the index or the score is showing like 4? Is it showing that the effective activity and efficiently of risk management being implemented in an organizations, Pak Suryo and Ibu Lina? How would this process to make sure that there is no finding in internal audit, for example, it makes sure that internal risk management already effectively implemented in an organization. Please share some thought about this before I continue to the next question.
Well, I think Pak Fajar measuring the maturity, one of the, well, maybe not one of the, but the main objective is, the main objective of risk management implementation in a company is to ensure that the implementation has become part of our culture, part of our daily activities, part of our process. So we don't need to ask, or we don't need to give reward and punishment to everyone in implementing risk management. It is already part of the habit. I think that is very important, ya Pak. So if the result of the maturity index or the maturity measurement are still, well, I think the highest is 5, ya Pak. Whenever our score is around 2 or 3 or 4, yeah, I think that we have we still have so many homeworks to do, and also I think it's a never-ending journey, Pak. Considering that every day, every month, every year, there is always a change in the context, in internal and external. Maybe today, or maybe this month, maybe my company is already satisfied with our achievements, but we'll never know the future, Pak. There is always a possibility that a company got a change in shareholder. There is always a chance that the board of directors will change. There is always a opportunity that the government will change the regulation, and whenever those changes occur, we have to go back to our desk. Have to go back to our laptops and to think the strategy, and also we have to think what's best to support the company, and the next day, or the next month, or next year, then our maturity will change again if we don't follow, or we don't adapt to the changes. That's it, Pak.
Okay, thank you, Pak Rima, for the sharing. Ibu Lina, could you please share your thoughts on
Yeah, I think about the maturity. I think risk culture index is one of them. However, we also can see from the other indicators, such as how many operational risk incidents during 1 year. This is also will reflect, and also not only about the incident itself, how many days each department report to the risk management about if any incident and so on. Yeah, other than that, we also can see from how many findings that its department breached the risk policy and also risk limit during, as we know that we have the risk appetite for across the company, and also we have SOP, and also we have policy, and we can measure how many breaches that they don't comply with those policies. Other than that, we also can see the maturity of risk management. How many incidents that is there any significant regulatory or ethic findings so far. We can flashback from from those findings, and also we need to measure compared to prior year, this year, and also I think we can also compare from the prior years again. We need to check and also monitoring those findings as well. Yeah, I think those of them is part of the indicators how the maturity of risk management amongst the company. Yeah, I think this is my thought, Pak Fajar.
Okay, thank you very much, Bu Lina. Now we go to the next questions, and I think this is also the last questions because the time is not allowing. We have a greeting from Ibu Titania, a fresh graduate student. Yeah. The question is, could the risk culture to be recorded as part of knowledge management? If could, how you do it? Yeah. Well, it's a good question because as far as I know, when you're talking about culture, it's talking about an abstract, something that cannot be touched or I don't know. Yeah. So who wants to answer first, Pak Suryo Rimba or Ibu Lina? Whether risk
Bu
culture
Lina, please,
recorded.
Bu.
Okay, let me start. Yeah, about the knowledge, I think agree. This is right. Risk management. This is like the virtual knowledge and so on. Therefore, I mentioned before that we need to embed the risk management from the beginning, which is if any joiner to the company, we need to give them like what is risk management, what is the useful of risk management, what is the difference between issues and also risk management, and then after that we need to maintain about the training itself regularly. And what we have now, we have the risk management trainings for the leaders, but then we also ask the leaders to cascade down those knowledge to their respective team. So we try to have like regular trainings to make sure that they understand what is stress management regularly. Not only one off training and they know, but they will not implement in their job, something like that. Yeah, I think this is my view about knowledge of risk management, Pak Fajar.
Okay, thank you, Bu Linawati. Please, Pak Suryo Rimba.
Okay, Pak Fajar. Yeah, definitely I agree. And I also think that risk culture can be part of the knowledge management. Well, not only can be part, but it is a part of the knowledge management. And there are many ways in building a risk culture in an organization. As mentioned earlier by Ibu Lina, we can give training, we can do campaigns, we can do disseminations, we can do many things. We can also do surveys, but I would also like to highlight that one of the evidence that risk has become part of the culture is by knowing that everyone in the company has implement risk in their daily activities. Whenever they simply comply to the regulations of the office, for example, not only smoke in the smoking areas, or always clean your desk, always submit your deadlines on time. You can you always make decisions based on data, based on risk. You always document. You always document your meetings. That is part. That is all of them. All of them are part of the all of them are part of the culture. And also risk is also part of that culture. If we know that at least, like I mentioned earlier, that every leader, whenever every leader, they make decisions always based on risk, no matter if you ask for them or you just leave them to do their job, you know that they will make decisions based on risk. By knowing that, you already know that risk has become part of the culture. And how the company do, or how what effort the company did in building the risk culture, you can always document all of them, document videos or methodologies, approach, and everything as part of your knowledge management. So in the future, the next generation in your company can learn from the past. They can learn from success stories, because we always know that time changes, people changes in the company. There is always a change in the internal and external context, and it is very important that the success stories and also failure stories in building risk culture is well documented in knowledge management. I hope that can answer your questions, Ibu Titania.
Okay,
Fajar.
thank you very much, Pak Suryo Rimba, for very clear presentations and very clear um, explanations, also from Ibu Lina Wijaya for sharing the implementations of how become a CRO, yeah, in such a huge company, yeah, in Manulife. So this is gonna be the end of the sessions. I probably need to wrap up a little bit. Yeah, what we've heard from Mr. David Koenig and Mr. Todd Davies, we learned that yes, the responsibility of the success of a company, yeah, is part of the CRO's obligations, yeah, responsibilities. Yeah, although we know that CRO is probably not in the business directly as such as a CEO, CFO, COO, and the CEO, yeah, but the informations that given, the methodology that being used, yeah, to recognize, to identify the risk from internally, externally is very important for the decisions that a company or organization is going to make in the future years. Yeah, and that is very critical. And also from Mr. Suryo Rimba Suroto's and Mrs. Linawati Wijaya's experience sharing today, we also know that risk management is not the CRO's job. Yeah, it's the risk owner's job actually. Yeah, so in which we have to share this to everyone from the top level to the bottom level. Yeah, through probably the culture awareness. Yeah, through the trainings, yeah, like Ibu Linawati Wijaya told us earlier. Yeah, training is one of the key to make people understand what is really risk management is all about. Yeah, it's not the obligations just for the risk management divisions, yeah, but it is part of the business. Yeah, so then the culture itself, yeah, must be maintained, must be developed. Yeah, along with the organization's growth. Yeah. So yes, we've learned a lot. I've learned a lot. I've gained a lot from this extraordinary speakers that we have today. I'm sorry for any questions that probably not answered, yeah, through the question and answer from the what is it? There's another note in here, but yeah, the time is running so fast. I have to return this to Ibu Nita Priscilia.
Okay, thank you very much, Pak Fajar Proboseno. Let's help assist me to give a very, very round applause for all the speakers today. Thank you very much. Thank you once again, Bu Linawati and Pak Suryo Rimba for a very clear, insightful sharing and also for answering all the questions and facilitates the discussion with our participants today. So thank you very much once again to all participants for your participation, your contribution to the webinar. We do hope you had a great experience and get a lot of valuable insights, takeaways, and learnings. But before we close, please your help to share with us your feedback by filling up the feedback form, which link is provided in the chat room. So please take a look in the chat room. Afterwards, you will be able to download all the materials from today's presentation. Once again, on behalf of CRMS, I would like to say once again, thank you to all the eminent speakers, David Koenig, Todd Davies, Bu Linawati Wijaya, Pak Surya Rimba Suroto, and also Pak Fajar Proboseno as the moderator. Last but not least, please also help us to support our partner, a small enterprise called Mia. Maybe you could see the logo on the screen now. They sell frozen yummy noodle. Yes. They sell frozen yummy noodle in Shopee. So please help us support them by visiting their shop in Shopee and follow them. And you will get a privileged 20% discount. Perhaps you could try them as breakfasting menu for today, ladies and gentlemen. With that, on behalf of CRMS, I would like to say thank you all. Don't forget to always keep your mask on, do social distancing, and stay healthy. So, ladies and gentlemen, see you on our next program. Goodbye, and thank you very much once again.
Bye. Thank you.
Thank you, Bu Lina, Pak Suryo Rimba.
Thank you. See you again.
See you again, Bu Lina, Pak Suryo Rimba, Pak Fajar. Thank you, Pak.
Bye, everyone.
Bye.
Bye. Thank you, Bapak dan Ibu, ladies and gentlemen. See you again next time.